Hi, I'm Ed Tomlinson, Chief Investment Officer of Smart Monday. I'm here to give a quick update on investment markets and returns for members. It's been a very difficult 6 months in investment markets with war, inflation, and now interest rate hikes driving sentiment. A lot of our members have asked us, what does this mean for their super? Should they switch investments, or will the market bounce back soon? It's really important to remember that markets go up and down, but it's the long-term results that matter. As I'll explain, we continue to achieve competitive returns for our members. Also know that our smart coaches are at the ready to guide you when it comes to your super. What I can do now is give you a broad update so that you understand the results of this past financial year. Inflation and other negative forces we've seen in 2022 have caused share markets to fall. While the Australian share market held up well for most of the period, it fell very hard from April to June. Since the end of June, there has been a small recovery, and so far, our portfolios have had a good start to this new financial year. The key drivers of this volatility were actions of central banks, raising cash rates to rein in inflation risks. In the main, central banks were late to raise rates and are doing so aggressively to try and catch up. Given the return from bonds is determined in large part by expectations of future cash rates, their values have changed dramatically, resulting in the worst returns from bonds in decades. All of these factors add up to a pretty hostile environment for super funds, and this has impacted returns for members. Given what I've just outlined, it's no surprise that almost every super fund is reporting negative returns for members. Like many of them, Smart Monday's high exposure to growth assets means that it's also impacted by the global factors I've mentioned. We're always focused on long-term results for members. These are the numbers on the right of the table you can see here. This is where super investors should focus, and there our results remain attractive compared to similar funds, particularly the strong performance of our popular MySuper option across 5 and 7 years. It's this relative position that we're aiming to maintain when we design our portfolios. Markets may continue to be volatile as the cash levels increase. The share and bond markets seem to be suggesting that there's more economic pain to come. Now, hopefully, governments will manage to engineer a soft economic slowdown in attempts to reduce consumer spending and inflation. This would mean cash rates might not need to go up as rapidly as currently forecasted. These are the sorts of issues we're thinking about, and while we can't predict the future, we can improve our protection against inflation and the risk of economic shock. I would stress that our portfolio changes will be quite minor, as we believe the best way to achieve great long-term returns is to continuously own a diverse portfolio of quality growth assets. So what should members do? History shows that growth assets recover after shocks, and our view is keeping a long-term focus provides the best chance of achieving great results from this point. If in doubt, a good next step is to speak to a Smart Monday Smart Coach. Thanks for listening.